Welcome to the Paradigm Shift podcast, hosted in Buffalo, New York by Dr. Curtis Haynes Jr. Tech Tuesday, where we look at the stock market and we look at the various tools that we use in forecasting in the stock market. My title is Dr. Curtis Haynes. I have a doctorate degree in economics, and I've been studying political economy for close to 40 years, and I've been studying finance, particularly personal finance, for about 20 years. Right now, these particular Paradigm Shift podcasts are built around the idea of economic and financial literacy. First thing we're going to talk about, we got financial terms of the day. Something that's real interesting. It's called the Rule of 72, right? And so the Rule of 72 is kind of like a thing that people use, and the idea is that it's a way to determine how long an investment will take to double given a fixed annual rate of interest or rate of return. So if you divide 72 by the annual rate of return, an investor would be able to obtain a rough estimate of how many years it would take for the initial investment to duplicate itself. So if you look at this table right here, you have rates of return in the first column, you have Rule of 72 in the second column, and then the actual using the present value data, right? These are the actual years that it would actually take. And what you would notice, and then this fourth column shows the difference between the Rule of 72 and the actual number of years. So if you had a 2% return on your investment, it would take 36 years for you to pretty much double your investment, okay? If you had a 3% return, it would take 24 years. And what we're doing, we're dividing 72 by 2%, we're dividing 72 by 3%, that'll give you 24. If you're able to get a 5% return, right, it'll take about 14 years to double your investment. If you had a 7% return, it'd take about 10 years, 9%, about 8 years. And these are over here in the third column, these would be the actual number of years, right? If it was 12% return, it would take 6 years, right? 25% return, almost 3 years. 50% return, 1.4 years, etc. So those of you who just want to think about, like, when you're looking at your long-term investment, and think about if you have something like, say, for example, you have a defined contribution plan that gives you a 5% return, right? Well, it's going to take you 14 and a half years to double your investment. Okay, so that's the concept of the day, the financial concept of the day, the Rule of 72. All right, so check it out. Again, just something to be aware of. Now, what we're doing here, this podcast is, again, it's a economic and financial literacy theme, right? And this particular one, we're looking at the relationship between trading and investing in financial markets. A lot of you have Apple products. The price of a stock, an Apple stock, it goes up, it goes down, and a lot of the retail and the professionals use technical analysis to follow that movement, okay? You could use it to follow movements in option markets. You could use it to follow movements in cryptocurrency markets. You see right here, if those of you who've been participating in my workshops, my personal finance workshops, these concepts is that you have financial habits. And most of us, I myself, when I was a high school student, my financial habit, if you look right here, my financial habit was the financial habits of the poor, right? Money would come in and I would just spend it, right? When I got my first job, career job, teaching at Buffalo State College, at Buffalo State University currently, right? And my job, my salary increased, and then I started buying these liabilities, and I really wasn't paying attention to my asset column. And what I realized and what I learned, I studied Robert Kiyosaki. When his book Rich Dad Poor Dad came into my life, I really became, even though I was an economist, I became aware of these different financial habits, right? If this is your financial habit, money coming in, money going out, if you have this habit for the next 40 years, you're going to be in a very difficult situation because you won't have any kind of assets in your asset column. If you want to retire, you're not going to be able to retire because you're going to need some assets that can generate income for you.